Hello everybody. So today I wanted to give you an update on HIMS because HIMS is down over 70% from where it was trading just 6 weeks ago. The market is entirely irrational, and now the valuation of HIMS on my metric, which is enterprise value over gross profit over revenue growth, is a 0.087. So this is getting near to as cheap as I've ever seen HIMS, and it came down to a 0.05 back in the early days of the channel more than 2 years ago when I was covering the stock. The stock was trading between the $6 and $8 range. Of course, the performance of this stock for the past 2.5 years has been outstanding. It's returned more than 400% despite that 50+% recent drop. Volatility is vitality. Volatility is the price you pay for a higher return on a stock like HIMS. No financial advice, of course, but this is my third largest position, and I am looking to add to this position at these levels. I find it way too cheap. So this is a way for me to walk through the latest data that we have on HIMS and tell you kind of my thoughts. And this may be a longer video. I don't know just yet how much I want to say, but let's get started. So evaluation, you got that. Point number one, evaluation is I find it dirt cheap, very cheap. Definitely the bottom 10% cheapest in terms of low valuation. Even if you look at traditional metrics like enterprise value over forward revenue, you're at a 2.6, so 2.5 times forward revenue, 3.3 times gross profit, and 32 times adjusted EBITDA. But adjusted EBITDA is growing faster for HIMS than revenue. They actually more than doubled their adjusted EBITDA compared to last year, while revenue only, quote unquote, only grew 69% year over year compared to the prior year. So let's talk about revenue. Let's talk about revenue growth. You may have heard me say on the channel, revenue growth is the most important thing for me. And why? Because if the price to sales ratio remains the same year after year, then the rate of revenue growth is the rate of return on the asset, right? If the price to sales ratio stays the same, it's the revenue growth that's going to dictate how much the asset returns. And over time, if the markets are efficient, which they're not, but theoretically over time, a business should have return that pretty closely, in my experience, match the revenue growth, at least when they're stabilized, when they're operationalized, and when you don't mess that up with buybacks. Sometimes flat businesses have great stock prices that are moving up because of insane buybacks, but that's not the case for him. So we have a 50 million buyback program outstanding, not much. Okay, let's talk about revenue growth. Enough rambling. So the revenue growth is outstanding. There's been an inflection point in the revenue growth since the launch of their GLP-1 program offering, and really the takeoff of their GLP-1 offering. So we really have HIMS before GLP-1, where it was growing, in the 40 to 55% range, and we have HIMS after GLP-1, where it's growing in the 60-ish, 65-ish% range year over year when you include GLP-1s. GLP-1s are now the fastest growing category of this stock, but I don't think this stock should be trading on GLP-1s alone. I think this makes absolutely no sense, that this stock is only reacting to GLP-1 news when GLP-1 revenue for the full year 2024, the only and latest data we have, that revenue for the full year is only 15.6% of the total revenue. So this stock is mostly not GLP-1 with a high growth GLP-1 division. Also note that the growth in subscribers is in line with the growth in revenue. The growth in revenue is slightly higher than the growth in subscribers, so this is good. This means that you get cross-selling. Your existing subscribers buy more year after year, and you add new subscribers to the platform. And of course, this is a subscriber business. Most of the revenue is recurring, which is why so many people love it. If you look at the categories in 2025, we will have 5 categories that are expected to return more than $100 million in revenue. So that's sexual health, that's mostly ED. You have dermatology for men and women, the HIMS and her side of the platform. You have mental health, SSRIs are very blockbuster drugs in the US. So many people are on SSRIs. HIMS makes it easy for you to access your mental health treatment. And now you have weight loss, and you're going to have many more categories in the future. These categories categories in the future of the revenue growth in the future will come from categories such as, and we're going to go briefly through them. So we have testosterone treatment. That's going to be able to be done soon because we're going to have the lab testing. They acquired a at-home lab testing company. You may remember that. We're going to have menopause. So this is HRT, right? Hormone replacement therapy. That's going to be a big part of the sexual health business. Prostate. So I don't know what they're going to do for that. I don't know what type of medication they could prescribe for enlarged prostates, but I'm pretty sure it's a huge market. And fertility, also a huge market. Dermatology. Note how some of the more widespread conditions in dermatology like eczema are not treated yet. So that's going to be future business. Then mental health. I follow a stock called Talkspace, for example. PTSD is a huge market, especially in the United States. There's probably, in my view, probably 100 million of revenues right there, especially with the military with PTSD. Insomnia is huge. Substance abuse is huge. Notice how some of this is synergies, right? If you look at substance abuse, well, I could definitely see some synergies with GLP-1s because GLP-1s have been, associated by a lot of serious sources to help with substance abuse. People on GLP-1s can't have a beer. If they have a beer, they want to throw up because they're on GLP-1s, right? So there's cross-selling in between each section. And of course, the 100 million category right now is weight loss. So we have insulin resistance, right? That's the GLP-1s. That's everything that has to do with the regulation of insulin, the diabetes. All of these GLP-1 drugs used to be diabetes drugs, and now they've been expanded. We've added more optionality to the drugs, more things that the drugs can treat. But they're getting into things like appetite control. They may get into digestion, and they may get in the appetite control. Of course, that's their bars and their shakes. You may have followed that if you follow the stock. And diabetes is a big kahuna. If they were to actually treat diabetes, that could be so huge for HIMSS. So the growth, I hope you can see how the growth may be unabated for years to come if they expand in just these categories. And of course, this is just the tip of the iceberg of the health issues that they could treat. HIMSS focuses on mostly mild health issues, but with their acquisition of the lab testing, the at-home lab testing company, I believe they will be able to treat what I'm going to call the medium health issues, such as diabetes, right? And they'll be able to do that. Why? Because they have labs and labs testing. And, they may get into physicals, right? They may do physicals. They may do urgent care. There's a lot of things that you can do remotely nowadays. And HIMSS is in a good position, in my view, to capture this market. Now, talking about the growth and the repeat usage. So if you look at the growth comes, new subscribers are a major share, are a big share. New subscribers are still a bigger chunk of the growth because they're in growth mode. What's important in this chart is to note that the repeat customers grow, maybe not as fast as new subscribers because we have GLP-1s. A bunch of the new subscribers in FY24 were GLP-1s, but it still grows more than satisfactorily, right? We're still at 30% growth in repeat customers as well as new customers. So the growth is happening across the board. I want to talk about marketing. If you follow this stock for a while, you remember a few years back, everybody was saying marketing sucks. It costs too much money. HIMSS spends too much money on marketing. Remember that Super Bowl ad? I can't remember how many millions they spent on that. They spent too much money. Well, they've now published the data on the marketing spend, and you can see Q1 of acquisition, right? You spend $113 to acquire a customer, and you only earn 61. But Q2, you're breaking even. You're breaking even in Q2 because 69 plus 101 is superior to 113. So this is well under a year of payback on their acquisition of new customers. So this is pretty darn outstanding if you ask me. Oh, that's actually cumulative. Never mind what I said. It's Q3. It's Q3. They're making their money in Q3. I just read the cumulative here. But you get what I mean. It's pretty darn outstanding that in Q3 they're repaying their investment. They are well under 1 year in the payback period. So it makes a lot of sense for HIMS to invest a bunch of money on marketing, which they do much to the despair of the market, but they've been decreasing the share of marketing spend as the EBITDA margin has been increasing. I'll get to that in a second, showing you the P&L and the EBITDA margin. Let's look at some marketing data. And this is Bloomberg's second measure. This is the source of the marketing data. That's the market share. What's the market share in total sales of HIMS in the telehealth world? And you may recognize Roman. Roman is huge. Noom is huge in GLP-1 actually, but Roman is a very big one. BetterHelp. Why do we have BetterHelp? BetterHelp is Teladoc's mental health division. Teladoc's mental health division is BetterHelp. So anyways, if you compare all of these, pretty well-known companies, especially in the case of BetterHelp and Roman, you can see they don't even get close to the market share of HIMS. HIMS is the black hole acquiring the customers. They have 47% of the sales and 47% of the customers, roughly, according to Bloomberg. This is pretty darn outstanding. And look at the direction, right? Most of the competitors are actually growing aside from Roman, which is also taking some share. And sure enough, when you look at podcasts, it looks to me like Roman is seeming to be, somewhat of a competitor for HIMS, and RexMD from LifeMD. LifeMD owns RexMD, which is also a competitor. RexMD is not in this chart, so, it will be interesting to see where the market share gets in the future, but they are definitely the big player in the telehealth space. Moving on to profitability. So let me talk about profitability a little bit. Of course, subscriber growth, revenue growth, it's outstanding. You see revenue growth was 69% year over year. Subscriber growth was slightly lower, but still in line with the revenue growth. We've had GLP-1 outstanding at 45% subscriber growth. This is where you see the operating leverage kicking in. While, let's say, the subscribers only grew 45%, the EBITDA margin, so that's my proxy for cash flow, it doubled. We had a doubling in EBITDA margin. So if I were to simplify things here, the business grows at 60%, but the EBITDA margin doubles. So that means that we should expect going forward that the EBITDA margin is inevitably going to grow faster than the revenue growth, as of course those fixed costs get covered by a larger and larger revenue share. This is how businesses work. This is called operating leverage, and HIMS has operating leverage clearly kicking in. I'm not talking about GAAP earnings in my videos. I usually don't find that to be a reliable metric. I use adjusted EBITDA margins, as do most CEOs, by the way. Why? Because it's comparable. It's easy to compare yourself to the performance of someone else. Earnings to the disagreement of much of Wall Street, I believe earnings should be optimized to be low, because low earnings means low taxes. That's what I think most businesses today do. Anyways, moving on to payback period, as I said, is under a year, so they should keep spending pretty big on marketing, and I can make an argument even under 2 years they should also spend on marketing. The gross margin is 75+%. It's actually higher than that. If you go back to my page 1, we're at 79% gross margin in my evaluation. More than 90% of the business is recurring revenue, and if you follow this company, for example, you may have seen their products at CVS, for example. They sell like condoms or whatever on CVS. Why do they do that? They do that for brand awareness. They've said that their distribution on things like the shampoos on Amazon and whatever, it's all about brand awareness. They look at the non-recurring revenue. They look at brand awareness. They want to be seen on the shelves, and I think that's a very clever way to look at marketing and marketing spend. And so they don't focus on these channels, they just happen to be there. So if you look for a hair loss shampoo on Amazon, you'll have HIMS, and you'll see it's a very well rated shampoo, but it's not the core business. It's just a side thing. Moving on to long-term vision, and this is the big deal, because they give us guidance until 2030, not a number in revenue, but they give us gross margin guidance and long-term adjusted EBITDA guidance over a long run, and that's a business that I want to hold beyond 2030, because I firmly believe they're going to take a big chunk of those pharmacies going out of business, and they're going to take a big chunk of those mom and pop doctors going out of not necessarily going out of business, but typically being acquired by bigger clinics. Typically what happens in a town is you have a family doctor, XYZ last name, MD, and they hire a few MDs, and then it gets so complicated with reimbursement issues and delays and all that sort of stuff, and they get acquired by a big group like United Healthcare. So the mom and pop pharmacy, the mom and pop doctor, although there's not a lot of mom and pop pharmacies anymore, these, in my view, they're getting disrupted by these vertically integrated, highly lean companies, of which Hims is the best, as evidenced by market share. Again, no financial advice, that's just my view. Let's look at the 2025 outlook, so more short-term outlook. They're guiding, and Hims has a history of sandbagging. You may remember their 2025 guidance 2 years ago. They beat that out of the park. They were predicting 1.2 billion in revenue, and I'm looking at now a new guidance of 2.4 billion in revenue. So Hims is very good at sandbagging. As most companies do. Most companies are sandbagging these days. Why? Because the market gives them no credit. So why would the manager put themselves in a poor situation? Anyways, the guide, so I'm going to take the higher end, 63% year-over-year revenue growth is what they're guiding for the full year of 2025. They have not reported Q1 yet. I think they will be on track. I'm not sure, but I think so. That's why my third position in the portfolio. And you see long-term retention, 85% plus. Tons of really good metrics. They want to achieve 725 million of revenue in weight loss in 2025. So what? That's going to be about a quarter of the revenue in 2025. It's still a business that would be like 75% not GLP-1s. And I bet you the stock is going to keep trading based on GLP-1 news in 2025, even though 75% at the end of 2025, 75% of the business by then would not be GLP-1. But they're still going to be trading on that because the market likes narratives too much. The long-term adjusted EBITDA margin is outstanding at 25%. I mean, you're not like semiconductor grade or Nvidia grade, but you're super high grade for the healthcare sector, and I find that very compelling. This is a business that's going to have a lot of cash flows to reinvest, and then potentially a lot of cash flows to either buy back stock or buy Bitcoin, whatever, something like that. Hopefully not an acquisition. Hopefully you don't want to see them use the cash to do acquisitions or just sit on cash like a company like StoneCo, for example. Anyways, strategic priorities. So now we're moving away from the numbers and just looking at how we're going to achieve that revenue growth. How are we going to achieve 2025 priorities? For 2025, 2.4 billion revenue. How are they going to do that? Well, first of all, they want to cement their leadership in weight loss, which they do have. And so we don't know what that's going to mean. I mean, we know the plan. The plan is mid-May, May 15, semaglutide non-custom solutions for semaglutide will have to be transitioned to new solutions or to just use the branded version. Customized solutions of semaglutide will be able to stay, but you need to have a documented customization in case you get sued. So I don't think it's true to say that all customers will get a customized solution because they add vitamin B12 and boom, you added a vitamin B12 and thus it's a customized compounding product and you get to still sell the compounded version of semaglutide. No, you need to have a lab that says, hey, there's a B12 deficiency. And that's why labs are so important for Hims, because they will be able to prove the need for customization when customization is needed, and then they can do that. In the case where customization is not needed, and you can bet, Ozempic is starting to introduce a lot of different size dosages, so that you can't really play on the dosage anymore to say a customization is needed. When you don't qualify for that, I think, and they've telegraphed that, they're going to try to switch people to liraglutide, which is the generic GLP-1. It's fully generic. Anybody can make it now. And Hims is going to have its own manufactured version of the GLP-1. They acquired a peptide facility, and they're going to make their own generic liraglutide, and it will be interesting to see how they brand it, if they brand it. And the CEO said on the call, liraglutide alone is on average only 5-ish% weight loss versus 10 10-15% weight loss for semaglutide, so it's not as good. But if you pair semaglutide with an oral-based solution like metformin or bupropion, and they use a few other molecules that are dirt cheap, by the way. That's how they achieve 80% gross margins. If you pair liraglutide with oral-based solution, then you can get with a very similar weight loss to a GLP-1 like semaglutide, albeit not as good as retatrutide, but tirzepatide, but Hims never sold tirzepatide. I think what the CEO has not discussed on the call is, are they going to launch branded solution like Ro has? Ro has a branded solution via Lilly Direct. They have a partnership with Lilly Direct where they sell tirzepatide. The CEO on the call said they can't do that because they don't have the volume, because the and it's understandable because Hims in the telehealth business is nearly 50% market share, so they don't have the volume, and so they've done that with the smaller players. It's not guaranteed they'll be able to do it with Hims, but I still think a commercially branded partnership with the big pharma companies is possible. But that's an assumption. That's my guess. It's not a guarantee. They need to have a volume. I think it's pretty meaningful that the CEO says on the call they don't have the volume, because it means, wait, it's not in shortage. If it's not in shortage, how come you don't have the volume? Is it really in shortage or not in shortage? And that's where the OFA versus FDA lawsuit comes into play. And this stock, if there were any good development in that lawsuit, this stock could pop. Lab diagnostic, we understand how important that is. That is, if you want to do things like offer physicals one day or offer diabetes care one day, you're going to have lab diagnostic. They acquired their lab testing company. I covered that on the channel before. It's a little kit. It's a Lancet kit. A Lancet is a button. It's a push button you put on your arm, and it's going to drip blood. So you have a few drops of blood that fall into a vial, and you take the vial, you mail back the vial to Hims, and then Hims will analyze your blood. They're going to integrate that in all parts of the business, and it means they're going to be able to go after medium level conditions that require blood tests. Then you're going to have personalized solutions. They want to move to everything personalized. This is a big trend in everything in business today. Everything is personalized in business today. Phones are personalized to us. Netflix welcome screen is personalized to us. Amazon's recommendations are personalized to us. Spotify is personalized, and health would be personalized, should be personalized, and they're expanding in that scenario. And I fundamentally believe in that. That's the way of the world, and you can do that with technology today. Of course, new specialty launches, they could launch their own peptides. So that would be very interesting. What if they got into the drug development and they developed certain types of peptides? Again, maybe worth a deep dive at some point as to what peptides are and how they work. But peptides, from my understanding, are some of the easiest drugs to manufacture out there. And so that's my understanding of it. And they're going to invest in their technological capabilities. That's things like MedMatch, and MedMatch, of course, is their recommender system. Amazon recommends you stuff you're likely to buy. TikTok recommends you a video you're likely to watch. Hims is going to recommend you a drug that's likely to work for you. But the patient does not see the recommendation. It's the provider who sees the recommendation, i.e. the MD, the nurse practitioner. And the provider says, okay, I agree with the MedMatch recommendation. I approve it. It has my stamp of approval. And that's the legal requirement of the health business, of course, is that you need to have a licensed professional prescribing the drug and following up with the drug to you. And of course, a big deal is all of the facilities that they acquired, expansion of these facilities. They're working on that. They're working on a 700,000 square foot in California, Ohio and Arizona. So that's going to be size anyways. Expanding facilities, that's one aspect. Increased automation is going to be a big deal. And this is all about automation. And I fundamentally believe in that as well. I think most businesses will have automated warehouses and run automated warehouses, and Hims will be one of those, and they'll benefit from that cost savings. And lastly, let me finish up with the platform and the platform strength. Hims is a platform. I know we tend to not think of it as a platform, but it's a two-sided platform. It's a two-sided platform like a Uber, like a YouTube, really. It's a two two-sided platform, and except it's the customers. So I don't know how many patients providers see a day, but my guess would be maybe 20, 30 patients a day is what the providers see each day. And they now have 1,300 providers. So 1,300 providers seeing, let's call it dozens, let's say dozens of patients a day. And so platforms are very hard to build. Think about a dating site with only men. You didn't grow the platform organically because there's only men, right? It's like think about Uber with only drivers and no customers. They're very tough to grow at the same time. That's why the market often gets this wrong, saying, "Oh, anybody can compete. Anybody can compete." Well, is Amazon going to go out and hire 1,300 physicians all of a sudden and just wait for the customers at a loss? No, these platforms tend to be very tough to build, and you need to grow each side of a business at the same time. And HIMSS has been working on that since 2007, and I think that creates a moat for them. And of course, we have the flywheel. So the flywheel popularized by Amazon, right? Good to great. The Jim Collins book. Jeff Bezos used to have Jim Collins. He used to fly them in the late 90s at Amazon to teach them about the flywheel. The flywheel is how you create an unstoppable business where each part of a loop makes the business stronger, makes the business spin faster and attract more customers. Kind of like a snowball effect. And the idea is a flywheel. The faster the flywheel spins, the more unstoppable it becomes. And so this is what they have. The more customers on a platform, better data. Better data, better solutions. Better solutions, better outcomes. Better outcomes, more customers. More customers, more data. More data, more solutions. More solutions, more better outcomes. And then better outcomes, more customers. That's the idea of a flywheel. That's how you win. That's this famous book from Good to Great. And so many, what I would call digital businesses, what I would call 0 to 1 businesses, what I would call businesses who really get a hang of business in the 21st century, show these flywheels. If your business doesn't have a flywheel today, it could be a red flag. Anyways, not always, but something like that. Innovation. Let's talk about innovation really briefly. Talk about that many times, but this innovation is mostly in the pharmacy space, so it's all about making people feel good. Take Viagra for example, the blue pill, right? It's stigmatized. It's highly stigmatized. Movies have caught on to that, and that blue pill doesn't have a good reputation. Well, HIMSS, they created hard mints by HIMSS, which is like just a mint, and it comes in something that you can easily fit in a pocket, and it's so much more customer friendly, so much more customer centric. It doesn't come with a stigma attached with, say, a Viagra. And they're trying to do this with all of their drugs. When you take a medication from the pharmacy, and you have that, very sick looking, like it makes you feel like you're sick when you take a medication at a legacy pharmacy. And that's because it's been there around and they haven't really changed. And HIMSS is trying to innovate with a form factor that don't make you feel like you're sick. And they use sprays, they use vibrant colors on the medication. And of course, if you're in the medical field, you may think it's fluff. But if you're in the field of business and if you're in the field of marketing, it's not fluff, because if people don't take the pills, you're not going to have good outcomes in the first place. People need to take the pills. You need to have patient adherence for the good outcomes to happen in the first place. And this comes with making the customer feel good. This comes with, focusing on all of these aspects. This also comes with things like easy access. A business in the 21st century needs to be accessed 24/7. It needs to be at the tap of a button, and it needs to be right away. This is what Amazon has taught every single customer out there. That's the reason why Amazon's net promoter score is in the high 90s, right? That's why everybody recommends Amazon to their friends, because they have taught that to the customer. And so think about the legacy health system, the ping pong, right? You want to get an ED treatment in the legacy system, you're going to go through the ping pong, because the provider provider may not be comfortable discussing that with you, so they're going to send you to the urologist. And so the urologist may say, oh, well, actually, you can just ask your PCP about that. Or the urologist may also not be comfortable, and the urologist is going to send you to a heart health specialist. And then you're just being sent between specialists, and 6 months go by because you don't see the specialist right away. You have to wait weeks, months sometimes, and you never get prescribed anything. So HIMSS changes that, of course, with its platform, because it's matching the patients to the doctors. And you don't have a doctor just sitting there in a new town waiting to grow the office. No, the match is automatic. And of course, the customer service, the convenience of a service, the data-driven, the personalized solutions, they help providers work faster by telling these providers what you do. And something we don't talk about much about HIMSS, and I'll conclude with that. That's the conclusion of my presentation. The platform strength is their records management system, their health records management system, their EMR system. They have their own proprietary EMR. And of course, if you know anything about healthcare, you know that everybody uses Epic. Epic is a bulky, powerful but bulky software. You know, it's kind of like SAP at banks or something. No offense to SAP, but anyways, it's not a very UI UX user friendly software, Epic, and you know, doctors probably come to hate Epic after a little while. Having a proprietary EMR with a beautiful user experience, a beautiful UI, literally changes your life as a provider. And so my guess is that they love to work on that. And if you work with Epic, you probably don't look forward having to write your notes on Epic, because the system is powerful but very, very bulky. And so that's why I think this is actually a powerful part of a business. I don't have any issue imagining them actually selling and licensing their EMR to other healthcare companies, just like SoFi is doing with Galileo and licensing Galileo to other banks. So anyways, we have consumer tools, consumer-facing tools. These are your notifications in your apps. For example, this is what comes with a GLP-1 business for a weight tracking, habit tracking. This is all built into the app. You have operational tools where you can connect and connect with the customer and help the customer with their questions. So it's all about how do you connect the chat box to the provider? How is it for customer service? Is it the provider network? Is it the care team who's going to connect with a chat box again? That's all operational stuff. I don't want to get too much into the nitty-gritty, but that's a big deal. And lastly, you have MedMatch by HIMSS that recommends either mainstream generic drugs and more customized pills, customized drugs in both a form factor and a marketing format that is appealing and that increases patient adherence, in addition to a customized treatment. For example, this is the hair growth treatment that likely has the biotin and the minoxidil amount that you really need for your own person, because one-to-one marketing teaches you that we're all unique. And so really, when a treatment comes in 500 milligrams, why is it 500 milligrams? Probably nothing to do with you. It's just some random person who decided it should be 500 milligram, and so that's why you get into very weird things, like sometimes pharmacists tell you, oh, you need to cut the pill in half. You need to cut it in half. Yeah, that's not very user friendly. That's not customer centric. That's not client centric. That's not the way Amazon does business. And so hopefully this gives you a good overview of the HIMSS stock and why I find it cheap and why I find this business so compelling. I hope you learned a thing or two. This was not financial advice, not investment advice. This is only entertainment on this channel. Always and only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.